Good afternoon, everyone. Good afternoon. I'm sorry for being a bit tardy. Um, yeah, I'm here. I'm here. I'm here. I was, I just lost track of time because I had to reply to so many emails. There were so many emails. I thought I was still, I still had time. Just, I just had like a 1 hour gap between my previous class and this one. I thought, I had still like 1 hour just passed by so quickly, uh, doing a lot of, things in between. But, sorry about
Hello,
that.
Professor.
Yeah, hi, I'm here. Khalid, you had something to say? Khalid, I heard I saw your microphone uh, light up. Um, but anyway, this will all, I missed, let's say, I'm like 15 minutes late today, but there was a time when, I gave you like more than 15 minutes. Uh, Khalid, can you hear me? I think it's your, okay, I'll have to, can anybody else hear me? My microphone is on.
Yes.
Okay, all
Hmm.
right, thank you. So I think it's just Khalid. Maybe somebody sent him a chat that it's his audio setting probably. Everybody else can hear me, right? All righty, let me. So eh, I was late by about 15 minutes this time, but there must have been a time previously that I gave you more, 15 plus minutes, in lecture. I mean, so it should all average out. So let's see. Let me just first check quickly where we were last time. Um, and since everything is there, all collaborate session recording is there uh, on the.
Hello, Professor.
Yeah, yeah. Hi, can you hear me? Is that Khalid? Khalid, you can't hear me apparently. Okay, let me just quickly check. Great Depression. So, um, after the Federal Reserve, CFPB, Consumer Consumer Financial Protection Bureau. So in our last class, if you go to the course material, I have course materials already. Why am I? Okay. Alrighty. So time is up. Okay. So uh, it is clear, we haven't gone into open market operation. I mean, we need to wrap it up because we are already into topic two. We've been already into topic two for quite a while, I guess. Let's see, if you go to course material, topic two, right? And we are into topic two today. Um, yeah, you have financial statements intro 4567, right? That's today's main lecture, right? That's today's main lecture. And uh, but since collaborate is a review and reflection, um, we're kind of behind, but we have to wrap up wrap up that topic. So we're gonna do that today. And I see some chat has been going on. Calling your sound every time someone sends a message in the general room, but no speaking. So it's not my headphone. Okay. So I hope Khalid can sort out his problem. It's just, some
Yeah,
technical.
I can hear
Okay.
now.
Okay. All right. So
Hey,
yeah, good, good.
yeah,
So um, as you know, so let's think about, let's think about how Federal Reserve affects the Fed funds rate. And once again, the importance of Fed funds rate is that the Fed funds rate is the bottom line, the baseline of all interest rates. Um, and all short-term interest rates, all short-term, right? Short-term means, maturity under 1 year. And the Fed funds, although the name is Federal Funds Market Rate, it is not uh, owned, or it is not dictated. It's not dictated by the Federal Reserve. I've been telling you. Fed funds market is basically a market for lending and borrowing between the commercial banks. Although Federal Reserve is the central bank and is the regulatory authority on commercial banking, the Federal Reserve doesn't dictate the market. And I've been talking about the free market. What is the difference? Why Federal Reserve cannot dictate the rate? It had because we are in a free market system. Uh, Nothing, the prices cannot be dictated by a central authority. Um, it's not just a normative statement, but effectively it won't work if the price is dictated. Uh, and um, so to understand how Federal Reserve affects the then so what the Federal Reserve can do is setting the target range for the Fed funds rate, and then the actual market rate will be determined by the demand and supply um, for funds between the commercial banks. That's what uh, and what Federal Reserve is trying to do is to keep the actual Fed funds rate within the target range, right? Through intervening in the market. And intervention sounds like already something a regulatory agency does as part of its regulatory uh, function. No, no, no. It's Federal Reserve gets involved in the bond market, and through bond market operation, it will affect the actual Fed funds market rate. So it's called open market operation. An open market means open bond market, and open means, of course, open to anybody. Just like stock market, bond market is open to anybody, and open anybody means individual investors and institutional investors, both domestic and foreign, both domestic and foreign. Okay, and of course, when we say investor, you must keep in mind it doesn't mean only a person. It's not only an individual. There are institutional investors, and institutional investors are basically asset management firms, uh, commercial banks, investment banks, asset management firms, hedge funds, insurance companies. I mean, in terms of the amount of capital they can mobilize, they are far greater forces in the market, both stock market or bond market. In any securities market, institutional investors are a far greater force than individual investors, because the amount of money they mobilize is huge. And individual investors at best, I mean, on average individual, someone like you and me, of course, you and me cannot be on the same level because obviously you, um, uh, you know, at my age as a college professor, obviously I can mobilize more funds than uh, students at, in their early 20s. But still, individual investors are only a fraction, right? Um, in terms of the amount of capital they can move around. Um, and wealthy people, wealthy, you might wonder, there are billionaires who are invest. Yeah, billionaires uh, invest through managed portfolio managers, right? They have their portfolio managed by professional portfolio managers. They don't, directly invest. Um, so, portfolio managers are institutional investors, right? So that's why. But the point is, uh, in open market operation, Federal Reserve buys and sells U.S. government securities in the bond market, and uh, that will affect eventually the Fed funds rate. Um, and so we are talking about the bond market, so we need to understand what bond is. A bond is a debt instrument, a standardized debt instrument. And what standard? It has standardized features such as $1,000 par value. Now, par value is also called face value, um, or maturity value, or redemption value. You must uh, recognize them by all these different names because it goes by different names. First, face value. Second, par value. Third, maturity value. Fourth, redemption value. Redemption. Um, so what that means is, bond is basically a debt. Okay. So the companies are selling debt. In other words, instead of going to the bank and borrow, if a company needs $10 million, they have three possible sources. One, they can go to the institutional lenders like banks, right? And then they can borrow 10 million. But again, borrowing, even if it is a very high quality company, even if it is a very high quality company, right? High quality type, still, banks are not easily lending without collateral. To borrow, 100 million, they will have to put up something, a physical asset like their plant or equipment as collateral, right? Even if they have great credit rating. Banks won't generally lend without any collateral. Second, also they can go to they can look, they can work out for private placement, borrowing 10 million from private investors. But again, either way, the in this case, lending or borrowing is just bound or related to one lender, only a single lender, either one bank. I mean, even if um, sometimes it could be a combination, I mean, two banks can lend, you can get a loan from two banks. Two banks can, separately 5 million from each, right? Or two banks, you can approach two banks, simultaneously as two banks come up with, some deal to lend, 10 million in some proportion. Bank A 70%, bank B 30%. But no matter what, uh, it's not gonna be easy, and they will most likely require collateral. Third option is selling bond. When you sell bond is, as I said, a standardized debt instrument. So face value is 1,000. On the face of the bond, it says 1,000. But this is what you get at maturity, right? This is what you get at maturity. So when you are and borrowing 10 million, so each bond is about 1,000. Face value is 1,000, but the selling price of the bond could be slightly below or above, right? Below or above 1,000. So it can sell for 900 or it can sell for 1,100. So to borrow 10 million, roughly about 10,000 bonds. They will have to sell roughly about 10,000 bonds. And in the bond market, I can buy, let's say, 10 bonds of this company. I mean, they can fund it from a large pool of pool of public lenders. Okay, makes sense. And another benefit is bond is a debenture. What is a debenture? Debenture is a loan that doesn't require any collateral. In other words, bond doesn't require any collateral. Of course not. I mean, if you're how can a company put up a collateral when there are like million buyers, bond buyers, right? I mean, if there are a million buyers and if each individual buys, if each individual buyer, investor buys just 10 bonds, that's going to make $10 million, right? I mean, not 1 million. What's that? Not 1 million, but 1,000 buyers buy 10 bonds each. That's gonna already bring in $10 million, right? And to each of these 1,000 bondholders, how can they conveniently slice up their put up collateral in slices, right? And it's not in even proportion. I mean, just for our thought experiment, I assumed 1,000 bondholders, and that would make it simply, just for the sake of simplicity, that would make it 10 bonds per 10 bonds per each individual. But the reality isn't like that. So bond doesn't require any collateral, and bonds don't pay. Bonds pay interest until maturity, and when the maturity is up, then they pay the final interest and the face value, right? The par value. And so you redeem $1,000. Hence, it is called redemption value. Or they redeem. You can also put the company in that position. They redeem their bonds by paying $1,000, right? Hence, redemption value. Also, that's what they pay at maturity, so maturity value. And the interest the bond pays is called coupon interest. Coupon. Okay, so if the coupon interest rate is 10%, coupon rate is 10%, that means annually 10%, and 10% of the face value. So annually you'll get $100, right?
So,
If it is a
Professor,
10-year bond, annually 100, but each coupon annual, it's by semi-annual. Coupon is paid semi-annually every 6 months. So every 6 months you get $50. Was someone saying something?
Professor?
Yeah. Go on.
Yeah, I
Go
was
ahead.
saying something. So So the par value is the amount of money that the bond issuers repay when it hits the maturity rate, right?
Yes, yes, yes. That's what it is.
Okay, and the maturity rate has nothing to do with what you
No, no,
just said, every 6 months.
there's
That's
no such
different.
thing as maturity rate. There is no such thing as maturity rate. Uh, rate
Date,
is
sorry.
percentage,
Date,
right?
date.
Yeah, what you're probably saying is
Yeah,
maturity value. Is that right?
yeah, yeah.
Yeah.
Yeah,
Maturity
that's what I
value is
mean.
the same thing. Yeah, maturity value is the same thing as the face value, par value, redemption value.
And so the but my understanding is that the par value is before they give the bond or issue the bond, but then
No, no,
the
no, no.
face value
That's
or
stock.
the
No, 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 no. That's stock. In case of stock, par value is stock's par value is like initial. It's the initial price, right?
uh-huh.
In case of
Okay,
stock, initial
so
IPO prices, called par value. But for bond, think about it. Stock doesn't have any maturity. Stock goes on forever as long as the company,
yeah,
uh, right? But bonds
stays
have no
as long as the
maturity
company
because it's,
doesn't shut down.
yeah, as long as the company doesn't
Yeah,
shut down, stock goes on forever, right?
yeah,
But the bond has maturity because it's borrowing. Borrowing must end at some point, right? So,
yeah.
uh, par value is, in case of bond, par value is the maturity value.
Oh,
Okay,
okay, that makes
and
sense.
it's the face
Now,
value, redemption value, right?
uh-huh.
All
Yeah.
righty. Mm-hmm.
I have a random question.
Mm-hmm.
When companies go public, can they go back to
Mm-hmm.
being private?
Yes, they can also go back private by buying back all the outstanding shares. Think about it. When company
Oh,
goes private,
that would cost
public,
a
that
lot.
means yeah, they are selling ownership, right,
Yeah.
to the public, right? That's
Everyone.
why, yeah, IPO, and that's why they go, how that's why they say
Yeah,
going public. Now, then
exactly.
but if you want to go private again, then you have to buy back. But then question is, uh, can is it? I mean, what if someone? I mean, some if you offer a good price, then there will be definitely shareholders that are willing to give up. But some people may resist, right?
Yeah, of course.
Of course. So it's not easy. Hypothetically, it is possible to go. I mean, theoretically, it
Private.
is, yeah, possible to go private, but in reality, it is not that easy. But of
Yeah.
course, earlier last year or 2 years ago, I think it was about 2 years ago. Was that guy? Tesla. Just his name escapes me. Elon Musk
Elon Musk.
was, yeah, Elon Musk was talking about going private because there were
Wow.
so many. He was he was, so uh, annoyed by the pesky, short
Investors.
sellers, right?
Yeah.
Those who were trying to, short sell Tesla. He was talking about, going private, back private.
Okay.
But
Yeah.
yeah, theoretically it's possible. But
But he wasn't able to do it.
he wasn't able to do it. He didn't
Yeah,
do it. And
I
yeah,
can't imagine it being possible for anyone to do it.
I mean,
Especially if you have a big company, I don't think you can buy back all the shares. But I understand what you mean. Theoretically, it can
yeah, yeah,
happen.
yeah, yeah.
Good
First,
to know.
you have to raise capital in. I mean, you have to internally raise capital to buy back, right, all of the
Hmm.
outstanding shares in the market.
Yeah,
And
exactly.
for doing that, I think he was trying to borrow money from some, Saudi prince, who is also a multi-billionaire, and by borrowed money, but even if I have 10 shares of Tesla, actually I have 2 shares of Tesla, and
Uh-huh.
if I'm being a really a hardball, a pain in his uh, uh, pain in his butt, I'm not selling those two.
Yeah,
He can,
exactly.
of course, but
I
he
wouldn't
can,
I wouldn't
yeah,
sell.
but two shares don't do anything, right? He
Exactly.
can he can simply he can simply ignore, and because two shares cannot bring down the price by short sell or whatever, right? Uh,
That's true.
um, but theoretically, definitely, it's possible. Now,
Thank you so much.
you're welcome. Where was I? Um, so coupons are paid twice a year. That's uh, again, when we say interest rate, you have to understand there are many types of interest rate. First of all, we generally refer to the going rate in the market. That's interest rate, right? So in other words, when you put your money in the bank, or when you borrow money from the bank, that's the going rate, right? Coupon interest rate is the uh, uh, interest rate that the bond pays, right? Interest rate that the bond pays. So this can be above or below the going rate in the market, right? The going rate in the market. Now think about it. If there is no if there is no if it isn't that difficult to borrow money from the bank. I mean, bank doesn't require any collateral, or they're not. So then that's assuming that there is no friction or no transaction cost to borrow. Then simply the decision between borrowing from the bank or borrowing from the bond market is simply the question of well, who has uh, who has better rate, who offers better rate. If I don't have to pay higher rate uh, uh, to the bank, then the company can borrow from the bank as well. But the thing is, the reason the company is using the bond market is uh, benefit is obviously because they don't have to deal with those transaction costs, or they don't have to deal with the frictions like uh, collateral, and they can just pay interest until the maturity, and it's also uh, the coupon rate can be lower than borrowing from the rate borrowing from the bank, uh, etc., etc. Uh, but bond can be also classified by who is the issuer. The issuer can be the federal government, local and state government, right? Federal government, comma, municipal governments, which mean a state government or local government, uh, or corporations, right? Businesses. So I didn't include municipal governments here, municipal bonds here, because municipal bonds have different face value. Municipal bonds have $5,000 face value. So I left it out, but they work all in the same way. Basically, they work all in the same way. First of all, Treasury, um, and also depending on the maturity. Now, the maturity can be classified into short-term and long-term, and the line is drawn on 1 year. If the maturity is less than 1 year, right? If the maturity is less than 1 year, it's short term. Maturity longer than 1 year is long term. But for Treasury, long term can even, break into two categories. I mean, this is just my classification, okay? They just call it long term, but if the maturity is between 1 and 10 years, it's called Treasury note. Treasury note. They have a different name. Maturity below 1 year is called Treasury bill. Treasury bill. And the maturity between 10 and 30 years is called Treasury bond. Okay? So the term bond for Treasury is reserved for like 10 to 30-year bonds only. Okay? and that's the difference. Uh, for corporate bonds, if the maturity is less than 1 year, it's called commercial paper. Generally, commercial papers have maturity of 30 days, 60 days, 90 days. Mostly about 60 days. They don't have, they don't use, they don't use, commercial paper. Um, I mean, with extremely long. Uh, I mean, theoretically, 360 days is possible, theoretically. But if it is 360 days, generally, it's not very, marketable. And they don't, but it's still possible. Um, and the
Professor,
yeah,
are you sharing content? I can't see. I'm seeing a black screen.
uh, yeah, I'm sharing my screen, right?
Okay,
Everybody else
something's
can see
wrong
my
with
screen, right?
Yep.
yeah,
Yeah, yeah,
something's wrong
yeah,
with
yeah,
my
yeah,
blackboard
yeah.
today.
Yeah,
I'm
check
gonna
check
leave and
your.
come. I'm gonna.
Yeah, you might need some tech support, or you or restart, or yeah, you gotta check your computer setting. So co- um, corporate bonds, corporate bonds have uh, so short-term corporate bonds are called commercial paper. Long-term corporate bonds are called bond. And here for maturity above 10 years, I put not applicable, but no, it's not. It's not that the corporate bonds don't have 30-year maturity. What I'm saying is very long term, that kind of classification is not applicable, right? It just for corporate bonds, it's just long term, right? Because they don't have any uh, separate classification, like separate names, right? And treasury, because treasury have different names, right? Treasury bill, depending on the maturity. If you call them collectively, what's the collective name? Collective name is treasury securities, right? Treasury securities, right? That's the collective name to refer to all of them. Now, also the bonds can be classified by, uh, oops, whether they pay interest or they don't pay interest, right? If they pay interest, they are called coupon bond, and we understand coupon is the name for bonds interest. Now, non-interest-bearing bonds, bonds that don't pay any coupon interest, is called zero coupon bond. Okay, zero coupon bond, literally, no coupon. Um, and a good, so you might wonder if it doesn't pay any interest, why would anybody hold a bond? Why would anybody invest in a bond? I mean, the reason bond is a basically lending. I mean, from the investor's perspective. But if you lend for no interest, I mean, what's the point? Uh, Obviously, if it doesn't pay any interest, I mean, there's no incentive. But
Exactly.
instead, that's why zero coupon bonds sell at deep discount. One good example of zero coupon bond, one good example is 30-year Treasury zero coupon bond. 30-year Treasury zero coupon bond. So the name is
What does that
30-year
mean?
Treasury zero coupon, but that's the official name. But it goes by the name U.S. Savings Bond. So if you go to the bank, you can buy U.S. Savings Bond, and if you will find that they sell for $500. They sell for $500. But the maturity is 30 years. The maturity is 30 years. So then what does that mean? Over a 30-year period, you paid, 500, but 30 years later you get 1,000. So 30-year holding period return is 100%, right? And
Mm.
then if you calculate, so if you annualize it, right? Because this is a geometric average. If you annualize it, it comes to like 2.34% annually, right? 2.34%. So it is definitely better than any CDs, these days. I mean, 2.34% is a very meager interest rate in the old days, but these days, it's a very hefty, very good interest rate these days. Um, but that's, capital gains. It's all capital gains. I mean, the return is like 2.323%, 34%. Um, zero coupon bond sells at discount. I mean, otherwise there is no reason to buy zero coupon. Now, and most corporate bonds are coupon bonds, and you can find zero coupon. You may be able to find zero coupon in some commercial papers, but not necessarily, uh, but anyway, so then also bonds can be classified by whether the selling price is above the par value or below the par value. If the selling price is above par value, it's called a premium bond. It's called premium bond. And if it is, below par value, of course, then it's called discount bond. Okay, so zero coupon bond is automatically a discount bond, right? It's automatically a discount bond. But discount bond is not necessarily a zero coupon bond. There are coupon bonds, but still selling at discount, right? But then why? Why do some bonds? Why are some bonds premium bond? Why are some bonds discount bond? Um, it's all because of the relationship between the coupon rate and the going rate in the market. For example, this is all logical reasoning. This coupon rate is 10%. This bond pays 10% coupon rate, uh, but the average market rate is 5%. Now, what's going to be the demand for this bond? Can anybody tell me? Hmm?
Mm.
The coupon rate for this bond is 10%, but the average market rate is 5%. What's going to be the demand for this bond? Anyone? This
The,
is just a logical. Huh? Someone was trying to say something?
yes, the coupon bond is 10% the selling price.
Yeah, yeah. Not the selling price. Price is let's say price is above par value, so let's say like 1050, 1100, right?
Yes,
And it's paying 10% coupon rate, uh, but the average market rate, going rate in the market is 5%. So what's going to be the demand for this bond?
it's going to have a lot of demand.
Yeah, the demand will be very high. The demand will be strong, right? You don't need to know what is the
Yes.
price, what is the price of this bond, but price is only the result. Price is only the result of this coupon rate. If the coupon rate is 10%, huh?
So will
And
we
the
learn how to calculate?
average mar- average rate in, average rate in the market is 5%. If I had $10,000, if I had $10,000, where would I put it? I would put those $10,000 into this bond because it pays 10% interest. I would do it rather than putting it in the bank. You understand,
Yeah.
right? Clearly, because of the interest rate is much better. So why would I put my money in the bank? I would put it in the bond. So everybody else, I mean, it's not just me. Anyone with the rational mind, rational thinking, will put their money into this bond, right? And this strong demand will, what will the strong demand do to the price?
It will lower the price. The price.
What? Strong demand will lower the price?
I mean the interest, the coupon.
No, 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 no. Why? Cu- Coupon rate is already given. It's already given, right? And but before I move on, who gave me the answer to what's going to happen to the demand? Who gave me that answer? That was a
Aura.
what? Aura.
Yes, Aura.
Aura. Okay. Aura. This is fnb 100, 1300. Yeah. Interest rate is the reason, and the price is the result. In other words, interest rate is the cause. Interest rate is the cause of the high demand, right? The 10% coupon interest rate is the uh, reason for high demand. So it's the cause. The high demand causes the price of the bond to what?
Oh, to rise, right?
Yeah, yeah, to
Okay.
go up,
Yes. Okay.
to go up. Is that
Mhm.
aura?
Yes, it's me.
No, aura. This time I can't give you 0.25. You got 0.25 for the previous
No,
answer.
it's
Uh,
okay.
yeah, but this time you initially didn't get it, right? Yeah, strong demand will push up the price. So the price will go above the par value of 1,000. Okay. Now, so that's what this is. These symbols are telling you. Let me increase these symbols. That's what these symbols are telling you. That I subscript C, I sub I subscript C stands for coupon interest rate. R stands for uh, market rate. If the coupon rate is greater than the market rate, the strong demand will push up the price. So it ends up being a premium bond. And it's exactly the mirror image. It's exactly the mirror image. If the coupon rate is lower than the market interest rate, average market interest rate, it will become a discount bond because uh, um, if the market rate is 5%, but this bond pays 2.5% coupon interest, right? 2.5% coupon interest rate, nobody will put their money into this bond. Everyone will put their money in the bank, right? So then demand for this bond will be weak. Weak demand will lower the price. So then it will become a discount bond. Okay, we are going to come back to the bond topic 5. I think topic 4 is bond. So we will, and that's we will talk more extensively about bond. But that is more on the bond valuation aspect, not institutional aspect. This is all institutional aspect. um, so then what is open market operation? Now we need to think about the open market operation. Now we understand. So um, so I said, Federal Reserve goes to the bond market and buy and sell uh, buy and sell bonds. That way, they will affect the result. It will result in the uh, uh, it will result in lowered or increased interest rate. Um, but to understand the mechanism, we'll have to do a little thought experiment. So assume zero coupon US Treasury with 30 years to maturity, right? So this is like a US savings bond, right? US savings bond. Just for example, zero coupon Treasury with 30 years maturity. And we understand, we know it sells below par value, right? Of course, it has to sell because it's zero coupon. And let's say, so P sub T, right? That's the selling price of the treasury, right? T, that subscript T stands for treasury. So the selling price of treasury is less than the face value. Yes, of course. And this difference between the face value and the selling price is called the bond discount. Now think about it. If you buy U.S. savings bond, I told you you can buy it for $500, right? That's actually the going rate. I mean, I had a chance to buy U.S. savings bond about 20 years ago. I went to the bank and I just to make a deposit, or I don't know, to withdraw money, or the teller was trying to sell U.S. savings bond to me, but uh, they go by different names, like triple E bond, Series E bond, Series E, Series. Every time they issue those bonds, they will have different series, serial numbers, and starts with E or U or T, or, I mean, that was 20 years ago. I don't know what series name, it goes by. Um, but think about it. So the return, we understand the return is 100%. The holding period return is 100% because it's $500 over $500, right? $500 is the selling price, and the capital gains is $500. So this is 100%, right? But that's 30-year return, and this is called risk-free return. Risk-free return on the U.S. Treasury is called risk-free. Okay, it's called risk-free return. Why is it risk-free? Think about it. Nothing is safer, nothing is more safe than U.S. federal government, right? Why? Think about it. And here's the reason. No other bonds, corporate or government, are safer than U.S. Treasury. Why? First of all, U.S. First of all, when governments borrow, right? When you borrow money, right? When you borrow, basically, if you borrow money from the bank, what does the bank look for? They will look for, first of all, whether you have assets. In other words, whether you have wealth. Second, they will look for your income.
Yeah.
Third, your credit score. If you have, steady, good income. I mean, you have a stable job, permanent stable job that pays good salary, like $60,000 a year, or above. Your steady income is it's not put up as collateral, but that's the source of your funds to pay back, right? So someone with a higher income will have a better chance of getting approved for the loan. And for governments, what is that? It's the tax. Government's income is tax revenue, isn't that right? Government's income is tax revenue.
Yeah.
And U.S. as the tax revenue is certain percentage. Tax revenue is a certain percentage of the GDP, national income, right? Gross domestic income is the total, GDP is the income of the U.S. economy, right? So federal government's tax revenue is some percentage, of that uh, GDP, and the GDP of the U.S. is uh, the highest in the world as of 2018. That was U.S. GDP. As of 2020, I'll have to look, but it was probably about 21 trillion or 22 trillions. European Union, right? The whole European Union as an economic bloc, as of 2018, it was about 16 trillion. China, 2000 as of 2018, about 14 trillion. Japan, 5 trillion. Germany about 3 trillion. UK about 2 point some trillion. France about 2 trillion, 2 point something, 2.5. The countries that have more than 1 trillion are generally, industrialized nations. 1 trillion is already something like a cutoff line for advanced economies. OECD, all organization of economically, OECD stands for Organization for Economic Cooperation and Development. That's G, or a dozen countries, more than a dozen, 15, 16 countries, they have somewhere around 1 trillion, above 1 trillion, and some countries don't have 1 trillion, less than 1 trillion, still part of OECD. But anyway, the point is, the higher the GDP, the higher the solvency, the ability to pay back. Okay, because the tax. So then think about it: who has better solvency than U.S. government, right? That's the reason. Right? That's the reason why. And as long as there are, now let's think about it. If the selling price of the treasury goes down, suppose this price
Do you
goes down, right? Selling
do you
price.
mean do you
From
mean do you mean the price drops or they decrease it?
It naturally goes down. They don't.
Oh,
They
okay.
don't. It's a market. It's a market
Yeah,
mechanism.
that's what I'm asking. Okay.
Yeah,
So
yeah.
so
So
if it naturally goes down, okay.
because of demand and supply, why would it go down?
Oh,
If the supply goes down, I mean, not supply goes down, but if the supply increases, right, the price will go
yeah,
down,
because
right?
they want to
So the
sell
selling
more.
price is not, let's say before the selling price was $500. Now it's, 400, goes down to $400. Then your return, will have to go up. Isn't it right?
Mm-hmm.
Because
Yeah.
the numerator goes up, right? Numerator goes up. It's the same denominator. As the numerator goes up, the whole fraction goes up, right? This is very simple, simple mathematical mechanism, but nothing can beat this logic, right? So then the rate goes up. So it's just like that. Then how does the selling price of the treasury go down? Well, if the Federal Reserve sells more treasury bill, usually they do this with short-term um, uh, short-term treasury bill, because they are trying to affect the federal funds rate. Um, but in this example, this is a broad example. It's not only for Fed funds market, but for monetary policy to uh, if they want to lower the money supply, in other words, taper off, right? If they want to taper off the quantitative easing, what they will do is they will increase the supply of treasury, right? Sell more treasury, and then the price goes down. As the selling price goes down, return goes up. Now that means Treasury is the U.S. federal government is the safest borrower, right? And if the safest borrower uh, raises the return, right? Then all the other borrowers will have to raise the return. In other words, Treasury is the biggest player in the bond market, right? Because it's the biggest borrower. It is the most, safest borrower. So most, influential guy in the market, influential player in the bond market. So in the bond market, they sell more Treasury, price goes down, return goes up. So then all other bonds must raise their return. Okay. Of course, return interest, coupon interest is only part of the return, but mainly by uh, because capital gains is also part of the return, but by interesting interest rate, right? Because the safest guy and the safest guy and the biggest guy, the biggest and safest guy is raising interest rate. Other others must all raise interest rate, right? Meaning, otherwise, everyone will only buy treasury. Corporations cannot borrow money from the bond market. They cannot sell bonds in the bond market. So they have to raise interest rate too, right? Does that make sense? Because they have to stay competitive. I mean, if they don't match the safest guy, not just match, but they will have to do better than the, right? They will have to pay better rate than the safest guy. Does that make
Exactly.
sense? Hmm?
Yeah.
So overall interest rate in the bond market goes up. When overall interest rate in the bond market goes up, banks will also have to raise interest rate because bank is also trying to lend, but bank is also trying to lend, but if uh, I mean, bank needs to also bank also need to borrow money. In other words, they need to take deposit. They need to take deposit, right? And if the bond market pays better rate than the bank interest rate, then all the people will go to the bond market and only put their money in the bonds, and the banks won't get any deposit. And if the banks don't dry up, deposits for the savings in the banks dry up, then they cannot lend money. If they cannot lend money, they cannot uh, make any. They cannot generate any revenue for the bank, right? So overall interest rate in the market goes up, and then if the interest rate goes up, that means for the borrowers, it's going to become more difficult to borrow, isn't it right? High interest rate means it's a good news to the lenders, but for the borrowers, it's a bad news, right? That will disincentivize. I'm tongue tied. Disincentivize, right? That will unmotivate the borrowers to borrow. And as borrowers, interest rates are high, we all know it's difficult to borrow. Borrowing goes down. As borrowing goes down, money supply goes down. As the money supply goes down, the economy will cool off. When they say taper off, uh, uh, they're going to start taper by the end of this year, blah, blah, blah. What does that mean? They will do this. They're going to do this, right? And of course, uh, selling more treasury securities, that's one way they can do that, increasing supply, or also uh, uh, cutting down on buyback. So let's take a look at the other scenario. If Federal Reserve buys back, Federal Reserve buys treasury securities. In other words, treasury Treasury securities were originally issued by the Treasury Department. Federal Reserve is like a broker or agent for acting as broker for the Treasury Department. If you think about it, I mean, it goes through and when Treasury sells bonds, uh, it doesn't necessarily go through Federal Reserve only. It goes through basically commercial banks, many channels, and the commercial banks sell, Treasury. There are in the market there are investors who are already holding Treasury, right? The bond holders, Treasury bond holders, Treasury security holders, Treasury bill, Treasury notes, and when uh, uh, and the Federal Reserve buys these treasuries or buys back. Basically, it's Federal Reserve was also part of the uh, this system. They sold treasury to the market, and they buy back treasury, right? Uh, if they buy back, that's a demand, right? And strong demand does what? Strong demand pushes up the price. So think about it. Then it's the opposite. It's exactly the mirror image. It's the opposite. The price of the treasury selling price will go up, right? Selling price of the treasury will go up because it's because of the strong demand. As the price goes up, what happens? Return will go down because the numerator gets smaller, right? Denominator goes up, numerator gets smaller. The whole fraction goes down. So risk-free return goes down. And if the risk-free return goes down in the bond market, all the other bonds can pay lower rate. So the bond interest rate, bond return goes down. Of course, coupon rate goes down first. So overall bond return, bond yield will go down. As the interest rate in the bond market goes down, bank also aligns their rates, so overall interest rate in the market goes down, and therefore as the interest rate goes down, then it becomes easier to borrow. Borrowing increases and the money supply goes up. As the money supply goes up, it has a positive feedback effect into the economy, so the economy goes up, economy gets stimulated, right? So this is when they are expanding money supply. This is what they do when they expand the money supply. Okay, and when, as I said, quantitative easing means massive. It's also called massive asset buyback. Massive asset buyback. So normally Federal Reserve will only buy back Treasury securities, right? But during the quantitative easing, what they did was they bought also uh, 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 not only the treasury but uh, the bonds or corporate bonds, right? So all the corporate bonds that, of course, it should be, at least treasury won't buy back any uh, uh, only high grade, right? They won't buy back below triple B, uh, below triple B uh, corporate bonds. Now think about it. Normally, what Federal Reserve sells or buys back is Treasury securities, but during the quantitative easing, if they bought also corporate bonds, right? That's private sector. I mean, Federal Reserve has no obligation. Uh, Treasury is very safe, so Federal Reserve, there's no risk. Federal Reserve is happy to buy back or sell Treasury, but corporate bonds, That's no, beyond, normal scope of Federal Reserve, right? But they bought back even the corporate bonds. That way, they released a lot of money supply into the market. They injected a lot of money supply into the market. Now, think about it. An interesting thing is, this sound when you buy something, you'll have to pay money, isn't it right? So when Federal Reserve bought Treasury securities, then they or corporate bonds and quantitative easing. That's the reason. Another name for quantitative easing is LS, large scale asset purchase, LSAP, large scale asset purchase, right? Because it included not only Treasury securities but also corporate bonds. So they have to pay money. But then, so you think they will, Federal Reserve will print money and pay? No, there is no transfer of actual money. They don't print money. First of all, Federal Reserve doesn't print money. Printing money is the job of the Treasury Department. Treasury prints money, not the Federal Reserve, right? Although on US dollars, it will say Federal Reserve note, but the Federal Reserve doesn't print money. Physical, not only physically, but also matter. When they say during the quantitative easing, Fed was printing money on a massive scale. Now, if they really believe, if they say that really believing that Fed is printing money, no, they are really wrong. They don't know anything. They just like to attack. They just like to criticize and attack the Federal Reserve. Federal Reserve doesn't print money, so it's just a metaphor. Actually, it's a metaphor. What happens is Federal Reserve simply between the commercial banks and the Federal Reserve, they have an ongoing balance sheet transactions. So between the I don't know if this was shown, but I'll have to find this file, so it's going to take time, but I think it could be. Did I have it here? I wonder. Yeah, central banking. Where is central bank? No, oh yeah, here. This looks quite messy. Okay, I'm not gonna use it. So let me use whiteboard. It will be easier with the whiteboard. So it's like this. Let's say, so here's Fed, Federal Reserve. And here's commercial bank. And the balance sheet, we're looking at the balance sheet of the Fed. Balance sheets have, asset side and liability side. Okay, so assets. And the liabilities. I will put it down, rather down here. So if, think of it this way, if Federal Reserve buys $10 million of Treasury, right? Treasury securities from commercial banks, We started a little late today, so I'm skipping, any break. If they bought 10 million Treasury, $10 million worth of Treasury, let's say Treasury bill. So asset side increases for Federal Reserve by 10 million, but that creates liability because they have to pay. I can't keep writing like this. It takes too much time, so I'll just liabilities. I'll leave it like that. That also increases liability by 10 million. Right? It increases the liability of the Federal Reserve by 10 million. In dollars, right? So liability goes up by 10 million, right? Now, that means from the commercial bank's perspective, their assets went down by 10 million in Treasury bill. That looks like F. The assets went down by 10 million in Treasury bill, so that's negative, right? Negative. It's positive. But their assets, instead, they got 10 million in reserve. In other words, cash. So they sold 10 million Treasury bill for 10 million to the Federal Reserve, and they received 10 million in cash. I mean, in reserve, not cash, in reserve. No real cash actually transfers. But what happens is, this is just a balance sheet transaction, meaning, suppose you got a loan. Is there anyone who has ever got a loan from a bank? Anyone among you that has experience of getting a loan from the bank? No. But what do you think? I mean, if you got a $10,000 loan from a bank, how do you know you got the loan? What do you think? How would you get that? How would you actually receive that loan? Does anyone have any idea? Are you there?
Yes.
Okay. So if you got a $10,000 loan from the bank, how do you know? How do you actually receive the loan? How do you know you got the loan? How do you receive the loan? Does anybody know? Because it looks like nobody knows. Okay, so let me just tell you straightforward because it's taking too much time. In the old days, they sent you a check in the old days, right? In the old days, but these days, maybe some banks still do that, but in general, they just simply make a direct deposit. You understand? It's electronic transfer. So direct deposit means what? between the banks, maybe between the banks, they may but think about it. Electronic transfer is not real transfer of money, not physical transfer of money, right? It's just electronically, electronically, adjusting the balance sheet between the two banks, and two banks have, these two banks have um, ongoing, relationship, business relationship. Um, so they have something to the accounts to settle, and the accounts will be settled later on. When accounts are settled, they have payments to make to each other or accounts receivable from each other, something to collect, right? So what this means is Federal Reserve's uh, accounts payable increases by 10 million, right? Because they received 10, they bought 10 billion, and commercial banks. Oops, why is it? I shouldn't be moving around. And the commercial banks accounts receivable, T-bill went down by 10 million, but accounts receivable increased by 10 million. And if you get a loan, it's just, you will know, because when you open your, if you must be all using mobile banking. You open your mobile app, all you see is, oh, your balance increased by 10,000. Your balance increased by 10,000, right? But that doesn't mean there is, $10,000 physically, right? And when you put your money in the bank, the money doesn't have your name on it, right? It goes all into the central vault, right? Central vault, where so the money gets pooled, and money gets moved around. You just you just have a digital record that you have $10,000. It doesn't mean the money is, stored somewhere for you. The money gets moved around. You just have a digital record. So just like that, and with the $10,000 in your account, which is not physical money, but just a digital record, you can write checks up to $10,000 or withdraw from the ATM up to $10,000. Does that make sense? Hmm? Do you understand? There doesn't need to be any physical transfer of money, right?
I think I
So it's just,
understand.
hmm?
I think I understand what you're saying. So what you're
Yeah,
saying
yeah,
is
yeah.
when you contribute the money, it goes in a vault with everyone else's money and it's lost. But then if you were to get it back, they just give you the amount that is stored on the digital record, correct?
Right, 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 right. But some of part of what you said, it gets lost. No, no, no.
Yeah,
I know what you're saying, but yeah,
it's like
but
adding
yeah,
sand to the beach. You can't find it. It's gone.
yeah, yeah, exactly. I mean, it doesn't stay in one place in physical form. It gets
Yeah.
moved around,
You just
right?
have the digital like
Right.
it's like a
And
receipt.
just the physical record or digital record of your deposit, that's what gives you the power to withdraw money
Exactly.
from ATM, or write checks up to 10,000. So exactly the same way between the Federal Reserve and the commercial banks, there doesn't have to be any transfer, right, of physical cash. Um, uh, as Federal Reserve buys $10 million of Treasury bill from a commercial bank, they will increase their liability side, accounts payable by 10 million, and the commercial bank will increase their uh, accounts receivable by 10 million. Previously they had 10 million in Treasury bill. They don't have 10 million in Treasury bill because they sold it, but now they have 10 million in reserve, right? But no physical cash is needed. This is just a digital record with the digital, $10 million in their balance sheet. They can make loans up to 10 million, right, to individual borrowers. Does that make sense? So this is how it works between the Federal Reserve and then the commercial banks. So suppose, think about it. Commercial bank, Federal Reserve, when in quantitative easing, Federal Reserve bought huge amount of treasury securities and corporate bonds from the banks. And then that means banks have now reserves they can loan. So loan goes up, right? And the interest rate is low, loan goes up, right? That's and then money supply goes up. Uh, there is a positive feedback effect into the economy, and that's what they say. Asset purchase. Quantitative easing means asset purchase. What does that mean? Federal Reserve buys the assets, which are usually treasury securities. But during the quantitative easing, not just the treasury securities, but even the corporate bonds, right? That way, the money supply increased. And then, those who were attacking Federal Reserve, the policy for using, it's just rhetoric, but they were saying, it's a metaphor, it's a rhetoric, and they are saying, Federal Reserve is printing money, by, large quantity, massive amount of, so we are, there's going to be an inflation, blah blah blah. Usually, that came from uh, the GOP, Republican side, and if someone really believed that, someone who said it really believed that the Federal Reserve is printing money, physically printing money and inundating this economy with, money supply to cause inflation, they were, if they really meant it, they were either, completely ignorant. Otherwise, they meant it. It's a rhetoric. They meant it as, it was a metaphor, and they used it as a rhetoric in a discourse, in an accusation to, make the monetary policy look bad. Of course, they did that under Obama administration. The quantitative easing started in under Obama administration. But think about it. A financial crisis in 2008 broke out as a result of, Republican administration, George W. Bush administration. And then, Obama administration came in and cleaned it up. Of course, Federal Reserve is not under the order of the president, but during the Obama administration, Federal Reserve used, quantitative easing. It took long time, but the economy recovered and expanded. And then, during that time, Republicans were attacking, using that rhetoric. Federal Reserve is printing money, inundating this economy with inflation. They did mainly to attack the Obama administration, right? Although the decision, this monetary policy decision, is not made by the administration, but made totally independently by the Federal Reserve. So anyway, and the chairman of the Federal Reserve was appointed by President Bush, not by Obama. So it was the policy action of the Federal Reserve chair appointed by Bush. So if they were attacking Federal Reserve, if they used that rhetoric to attack Obama administration, actually they were attacking their own administration, right? Decision to appoint Ben Bernanke as the chair of the Federal Reserve. That was the decision of the Bush administration. They were attacking. They were hitting their own foot with their own axe. You see, the expression, they are shooting their own foot, or hitting their own foot with their axe. With the axe. They were doing that actually. So anyway, then this explains quantitative easing. But what does that have to do with the Fed funds rate? So I'm going to have to wrap it up because we already, past. So, Federal Reserve is, basically uh, even without, quantitative easing, Federal Reserve is constantly doing this with T-bills. So if they buy T-bills, from uh, 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 they buy T-bills, and from buying is not a right term here. They can simply uh, move or without actual action of buying, uh, they can increase their holdings of the assets of the commercial bank, and uh, in return, increase their Federal Reserve's accounts payable to the commercial bank, and the commercial bank has more money now, more reserve in their asset side. And if they have more reserve, what do? Um, they will try to lend out if they have more reserve than the required reserve, minimum reserve, because it's in the nature of the bank. Bank will, if they have excess reserve, they will want to lend it out. Why? Because they don't. Bank doesn't want to sit on the money, right? Didn't I tell you the way bank makes money by lending money? So they don't want to have any idle funds, idle money sitting in the bank. They want to lend out. So when there is more reserve um, in their bank, they will try to lend it out. How do they lend it out? They lend it to, they find someone who wants to borrow, or if not, they will lend it to the Fed funds market, right? There are every day there are a lot of commercial banks trying to borrow money overnight, just for overnight or for short term. So they lend it to the uh, Fed fund market, and in the Fed funds market, uh, lending means more lendable money, more loanable money means what? More supply of funds. More supply of funds will cause Fed funds rate to go down or go up. Hmm? What do you think? More funds will make the Fed funds rate go down or go up?
Go up.
How can it make it
Go
go up?
down.
It will make it go
More
down
funds.
because it's more supply of funds. More funds are available,
Oh, I was thinking more
right? This
people
is a
were buying.
logical reasoning. Please,
Yeah,
the
I was
logical
thinking more
reasoning is
people
not a
purchased.
difficult thing. You must
Yeah,
stay clear, clarity of
uh-huh.
thinking, right? It's the clarity of thinking. It's not fud. It's not something fuzzy. Don't. It's not something nebulous, right? It's a very simple rule,
Okay.
right? People say, "Oh, there must be a lot of, uh, some people say, there are many factors, and it's easy to say many factors are involved in this,
Yeah,
right? It's just like saying it
yeah,
depends. It's an irresponsible answer when any you think it's very complex. So it depends. There are many factors. No, but first you got to start with eliminating all the fuzzy, thoughts and get to the uh, basic mechanism. What's the basic mechanism? Right? Basic mechanism
yeah,
is when supply goes up, price goes down, right? Demand goes up, price goes up. Demand goes down, price goes down. Supply goes down, price goes up. I mean, think about it. This inverse relationship, right? Stick to that clarity. I mean, it's a very when you boil it down to that, like this. This is showing you the mechanism of why how the rate goes up or go down. And if you can understand, if you can comprehend that, uh, but it's very simple but very lucid. You understand? It's very lucid. It's simple, but very lucid. It doesn't have to be complex. It's very simple logic. But being able to master that logic or not, that makes the difference. That makes the whole difference. Okay. All right. We are already, I've given you more than the minutes that I. Okay. Uh, all righty. We are out of time, so I'll have to. Okay. I'll stop sharing.
Professor, I have one question before we go.
Yeah.
What are we being graded on so far in this semester?
Uh, there has been no actual exam yet. All you've
Yeah,
done so far is the practice test.
which
Okay.
aren't graded.
They are. There's a score you have, but
I
they
know, I
don't
know.
factor into your semester.
Yeah, that's
They are
yeah.
scored.
So
They've been graded, but they don't factor into the semester grade.
into
Okay, it can help. It can help at the end of the semester if you're at risk of falling below B minus. It can kick in to boost your lower score, but until then
yeah,
it's not. Okay, it's just a practice. So far, depending
yeah,
on whether you get there's a participation point um,
uh-huh.
and attendance point. Okay, that's it.
And attendance.
Alrighty, I gotta go to a meeting, so I'll have to.
Okay. Thank you.
All right, Aura, you're welcome. Aura, you have a question?
See you on.
Well, I can ask you next Wednesdays.
Okay,
Yes.
all right.
It's okay.
All righty, I'll
Bye
see you guys
bye.
all on Wednesday. Take care, everyone. Take
Okay.
care.
Bye
All
bye,
righty,
everybody.
All
all
right.
righty,
Take care, Professor.
all righty. Signing off now. Signing.